Now for a view from the C-suite. Introducing the panel is Boris Baikovsky, Senior Director, Solutions Management and Consulting at SS&C Advent.
Good afternoon, everybody. So it's my pleasure to introduce the panelists and the moderator for the Fireside Chat. Before I do that, I just want to say thank you to the IAA for working with us over the years, and certainly we appreciate what the AA does in terms of cultivating and facilitating a lot of the collaboration that occurs amongst all of you. We're actually really proud to call many of you our clients, so thank you for allowing us to help you solve various portfolio management and compliance and operational needs for your businesses as well. So with that, I'd like to introduce the panelists. First, we have Tom Faust, Chairman, Morgan Stanley Investment Management. We have Carol Jeremiah, President of MFS Investment Management. We have Jennifer Murphy, CEO and founder of Runa Digital Assets. And moderating this Fireside Chat is Phil Hildebrandt, CEO of Siegel Bryan Hamill, also a very proud client of SS&C Advent. So enjoy. Thank you.
Well, thank you and welcome. Today's panel topic is a view from the C-suite. So Tom, I'm going to start with you. Can you lead off and maybe share with us how that view has changed since the great financial crisis, through a pandemic, and now into a very, very volatile market environment?
A lot of change in our business. I actually got into management in our industry about 25 years ago. And if you start from the perspective of 1997, you might say, what hasn't changed? Our industry at that point was dominated by mutual funds, dominated by defined benefit plans on the institutional side, dominated by active management, and dominated by a mostly white male industry. Some things have changed, some more rapidly than others, but certainly we've seen dramatic change in terms of product and structure and vehicles. Growth of passive relative to active, growth of exchange-traded funds, separately managed accounts, collective investment trusts relative to mutual funds. Huge growth in use and activity and volumes on the private side. All that has happened as the nature of competition, at least in most product areas, has changed, where price has become a factor in the conversation at an earlier stage, sometimes I would say inappropriately so. The face of the industry, what we look like, has changed. We've become more diverse. Certainly there is a long way to go, but there has been some change that's happened, certainly from the perspective of 25 years ago. A lot has changed. But I would say that more recently, the roles and the role and demands on a leader have changed quite a bit because there are social issues where leadership of investment firms are typically expected to take a position. That really didn't happen 15 or 25 years ago. There are issues of really radical change in how people work. Do I work from home? Do I work in the office? How do I balance that mix? What's the right work-life balance for me and for other people that I work with? How do we maintain a culture in an environment where we're not seeing each other day to day? How do you onboard new people into the organization when, again, not everyone is in the office every day? We've learned a lot of skills related to how to do video calls, but the long-term impact of moving away from most people being in the office every day, I think we're still struggling to maybe get a grip on what the implications of that are long-term and how best to deal with it. Markets go up, markets go down. Certainly we're in an exciting time today. I don't have a crystal ball other than to say that there are lots of reasons for thinking that equities, for one, are more attractive today than they were at the beginning of this year because of the price correction that we've had. While there are many reasons for concern about different issues around the world, certainly starting with geopolitics and global affairs and what's happening in Ukraine, but also including what's happening with monetary policy and can we make the transition from quantitative easing to quantitative tightening? All those things are out there in the market and for people to worry about. But the underlying drivers of growth in the world's economy and in value creation for investors, I think, remain in place. And I would say from a long-term perspective, we continue to be optimistic about the likelihood of investors earning good returns from staying active in the markets.
You touched on, we'll talk a little bit about talent down the road a bit, but one of the things I thought was interesting that you talked about was access to you, as through this, particularly through the advent of Zoom and through the pandemic. How did you feel, did you feel a big change in terms of your employees' access to you through Zoom, or was it pretty much the same, or how would you describe that?
Some people in the room may know this, but I've spent almost all of my career at Eaton Vance, you might say mid-sized asset manager based in Boston, that was acquired by Morgan Stanley in March of 2021. So in the middle of the pandemic, the employees of Eaton Vance were not only getting used to working from home in most cases, but also getting used to being part of a bigger organization, a much more diverse organization than Eaton Vance in terms of the business profile of Morgan Stanley. So I would say for us, it was particularly challenging to stay connected with our employees to make sure everyone understood what their job is, what the mission of the company is, and how we move forward when maybe they haven't met their boss or
even new hires.
Right. So I think I heard a statistic not so long ago that at Morgan Stanley, 25% of employees weren't there at the beginning of the pandemic. So what has their work experience been like, and how are we doing a good job bringing them on board and making them feel a part of a culture that they feel like they are comfortable with and they feel like they're doing important work? It's a big challenge.
Yeah, big challenge. I'll give each of you just a quick chance if there's anything you want to share on that. No? Okay. Let me pivot then to Carol. I know you're very passionate about thinking about long-term thinking across all aspects of our business. It's been 40 years since we've had interest rates actually go up. You've talked about a real market cycle. This may actually be a real market cycle now with a lot of submarkets. This also means that even with those new employees, a lot of these people have never actually done their job in an interest rate rise environment and an inflationary environment. What do you think, when you think about long-term and the implications of that short-term mentality that's kind of creeped in, how does that affect your ability to do your job?
Yeah, I mean, it speaks very loudly about the importance of culture and what your culture stands for, and cultures really are about your beliefs. So as whether it's people that have been at the organization a long time or it's the new people that have not seen a market correction, let alone a global financial crisis, it's to help them understand what those values and beliefs are. And a lot of it has to do with having a longer term view and valuing that within the organization. And so whether they've sort of had the experience in the industry or not, it's sort of started to be ingrained in how you look at strategy and whether you take a long-term approach. Literally every business decision that you make and how they watch you make those business decisions, the things you decide not to do because it represents chasing a hot dot or something that's too short term. And so I think, you know, it really does start at the basis of your culture and the personality of your organization and how important time horizon is. So I think that gets embedded. And obviously they have mentors to look at and watch in terms of how they deal with uncertainty and change. The only thing I was thinking as Tom was speaking to in the industry and what I've been talking to a lot of advisors and clients about around the world is not to forget the fact that we have been in a risk environment on steroids. Investors are, until recently, because there's been nowhere else to go because the cost of capital and rates are so low, that investors have had to take 5 times the amount of risk to get the same amount of return that they did 25 to 30 years ago. And so the implications of the results of it's been great for our industry because advice has been needed as all this risk has been piled into the markets, but it does really make us think about what are the implications of all that risk that's been taken, and how do we start thinking about managing our talent, our firms going forward as it really relates to managing that risk differently. Because not only has it been a lot more investment risk, as we know, into equity markets and private versus public, active versus passive, but also the growing negative externalities that is created through climate change and social inequality. You know, new risks that have to be taken on. And just circling back to the younger generation, I mean, it's also the greatest opportunity to have them recognize the purpose that they're stepping into. Because we're really witnessing one of the biggest changes of capital allocation that we'll probably see in our lifetimes. And it's just such an exciting time, but also one to mentor and guide people forward.
You talk about the risk and the need to take more risk, but there's also, maybe if you could just think about this for a second, there's also been very little penalty to risk in this free money era over the last 12 to 13 years. So people, I think there's, maybe we're finding that out this year, but the cost of risk was so low. I don't know if that's what you're implying or not.
Yeah, it absolutely is. And I guess what, my soapbox that I get on sometimes about time horizons is, as investors have loaded up on so much more risk, in the old days it was cash and fixed income. You had to try and get people into the equity markets when I started. But now that they're all there, we forgot about the power of time. And what we've done is started to breed short-termism into the system. And one of our biggest systemic risks is not just greenwashing of climate change and social inequality, it's long-term washing. We say we're long-term, and we've really got to prove that we are long-term. And because that is how you best manage other people's risk, is to understand the power of time. And I think that is something that allows us to really reflect back on today and then think even about sustainability, which has become an indirect way to force us to start thinking about time horizons again. So.
Yeah, we're repeated about short-termism at every turn. Quarterly results, investment consultants that are looking at near-term performance.
It's the whole chain.
Yeah.
And the impact on the issuers. We forget about the power of the influence we have on the issuers, and if we want them to perform better in the transition of what's happening, we've got to understand, again, the time implications of it.
Well, Jennifer, you are in a very unique position right now with what you're doing, and innovation in our industry, and much of the innovation that's come up over the last 10 to 12 years, we've seen and ultimately leads to the success and the growth of our organizations. But you've certainly embraced that with your new venture, which is digital. Can you please talk about the challenges you're facing being a pioneer, effectively a pioneer in a completely new asset class, some of them regulatory, which we just heard a little bit about, and just how you think about and why you took the risk of being innovative in this particular way?
Yeah, I think the biggest challenge that we face, that I face in this business, is disbelief. And I think the biggest challenge to innovation is actually disbelief. I'm old enough, and I think some of you are too, to remember a book written in 1970 called Future Shock by Alvin Toffler. And in it, he talks about the phenomenon of technology sort of relentlessly, exponentially changing our lives, changing what it's capable of. But we as humans are limited in our ability to accept and manage and even understand change. And so his observation was, at some point, relentlessly, technology will change faster than our ability to adapt to it. I don't think we're there yet, but I think we're getting there. So just one brief example, if we look at some of the most successful companies in the world over the last 40 years or so, companies like Microsoft, for example, they took 40 years to get to $1 trillion in value. Companies like Amazon and Google took 20 years to get to $1 trillion in value. Today, an asset like Bitcoin took 12 years to get to $1 billion in value, trillion, I'm sorry, that should all be trillions, $1 trillion in value, and I think Ethereum will get there faster than Bitcoin did. So I think there's many examples, but change is happening faster and faster. And I think when I got into the business, our way of handling technology, this was in the late 80s, was to be a fast follower. That was our way of letting others who were more technology forward sort of sort through what the new technologies were and learn from them about what we ought to adopt. I think that strategy is putting asset management at risk. So I think there are better ways to manage trying to sort through the many changes that we see. We mentioned many of them: AI, robotics, machine learning, et cetera, and digital assets is one of them. One of the ways we manage that, how do you figure out what to focus on and what is real, is we look for traction. We look for, rather than try to predict what will be, we just focus on what already is, what's happening right now. And to the extent that there are any of you, and I'm sure they're not, who still wonder if Bitcoin is a real thing, Bitcoin is 13 years old. It's used globally by countries, by states, by cities for taxes and many other purposes. It's a $1 trillion asset class in digital assets, so it's already a real thing. But maybe I can ask, how many of you are part of the Starbucks Rewards loyalty program? Not as many as I thought, but certainly a few. Well, within the next couple of months, as a Starbucks Rewards program member, you'll own NFTs, whether it's apparent to you or not. Starbucks is adopting a blockchain-based infrastructure and an NFT program in order to provide rewards to clients. But one of their goals is to have their clients not know that they own NFTs, because they don't want the focus to be on the technology. That's not the point for them. The point is to give people unique experiences and unique assets that they can get value from. There are many other examples. If there are NFL fans here, if you get NFL tickets, almost certainly within the next 12 months, you will own an NFT, again, whether you realize it or not. Ticketmaster and others who handle the infrastructure that is around NFL ticketing is increasingly NFT-based. So it may be closer to home in our industry. Companies like Fidelity. Fidelity's been a leader in digital assets for almost 10 years now, maybe longer. Fidelity, Schwab just got together with Citadel and others to create a new marketplace for crypto exchange called EDX. They're just launching it now, but their reason for launching is this is a $1 trillion asset class with over 40 million people just in the United States using digital assets currently, and many millions more, according to those who are launching this exchange, that wanting to onboard. Last example, KKR, you may have seen this, but KKR's most recent healthcare fund, their private equity fund, they're launching it in a tokenized format in a blockchain infrastructure. And the reason for doing that is, according to them, that operationally, administratively, and for trading purposes, it's their view that all of their private equity funds and assets must be tokenized going forward to manage them more effectively, to make them more valuable to the people that are holding them. So I think there's plenty of evidence that the change is already here in digital assets. It's happening now. And I think it's sufficient just to observe what's already arrived rather than trying to predict the future.
What's interesting about that, and I'm going to come back to Tom and Carol, but the interesting part about the distribution aspect of that is really innovative. Right? There's several reasons where that is innovation is showing up in the way it's delivered. You talked about the different vehicles, Tom, of thinking back over the last 15 to 20 years and how that's changed. It seems like in that part of the business, the more traditional, it's not so much new assets as the way it is more distribution, innovation. You guys want to share any thoughts on that? You talked about collective investment trusts and things of that nature.
Yeah, so the vehicles have, the vehicles through which people invest in what I'll call traditional assets obviously have evolved very significantly from mutual funds, defined benefit plans, which was most of the market 25 years ago. ETFs has, in many ways, completely transformed how not everyone, but many people invest. We are seeing, I think we're still at a somewhat early stage, but we believe that separately managed accounts, particularly for individuals holding taxable assets, offer the opportunity to move to a further level of customization, which I think is likely to be a trend that's with us for a while. And also there's some significant tax advantages that can come from holding assets directly then as opposed to through a collective fund. And really what drives that, to some degree, it's driven by tax and regulatory differences between different vehicles, but a lot of it is driven by technology. The mutual fund was developed by MFS back in the 1920s as a way for investors that wouldn't otherwise have access to buying stocks and bonds to be able to pool their assets to invest on a collective basis. Well, a lot has happened in terms of technology over the last 100 years that makes it possible to do lots of things, to buy digital assets, but also to buy and hold individual separate accounts at much lower minimums than were possible previously, and to really create a custom portfolio, because we're all different. We all have different needs. We all have different desires in terms of what our exposure is, what our key exposures are in our investment portfolio. And the ability to customize, I think, is a very powerful trend that will be with us for a long time.
If I could ask the chair of the SEC one question, is why is the pricing that they're causing in mutual funds still in the 1920s? Because they should all make it very competitive as the president of a fund family. Carol, anything you want to add to that?
Yeah, I mean, we spend a lot of time on the vehicles of the future and really think through about, what we should be doing. I would tell you we also spend as much time about what we should not be doing. And there, are concerns that we have around all the vehicles out there, and we think about even the active ETF, as tempting as that has been for us to want to forge ahead. I admire the leadership that Tom took in getting really things started. We still are hesitant because of being able to manage capacity, as an example, and things that we just want to make sure as we think about that end investor and we think about being true to who we are and not promoting short-termism, even though ETFs have a lot more benefits than really intraday trading. It's what is aligned with how we're managing money and how we show up. So the other piece, I think, from the innovative side, besides vehicles and obviously digital assets, is the thought about measurement. I mean, one of the things, again, is spending a lot of time and thinking about how we're going to measure differently in the future. Because if truly the systemic risks of climate change and economic inequality apply to every single business, this is not about investor choice. This is not about investor values. This is about actually identifying value in companies and their competitiveness for the future. We don't believe it's about a product. We think it is absolutely everything to do with how you are evaluating a company. But then if that applies, and we've all signed up for net zero, how are we going to measure that impact and allocating capital responsibly for the future? Our metrics in the industry absolutely, hands down, I will say it table pounding, have to change. The idea of short-term alpha all the time is not going to allow us to deal with anything in the future. And so it's not that that doesn't become important, it's how do we think of expanded measurements that are really going to allow us to get to the investment transformation and opportunity where the money's going to be made in the future. So to me, we're working with the Aggregate Confusion Project with MIT, really thinking about measuring impact and how to do it kind of as what I would say stakeholder capital versus ESG.
Well, it seems like one of the fastest growing areas, and I think it was touched on before, though, has been private equity, private investing. And that, by definition, has a longer term horizon because you can't really, any valuation in the short term is kind of is what it is. But
we need to worry about that. We need to worry that we made the public markets so unattractive that people just have to go private because it doesn't, who wants to go public today? If you're going to be held accountable in such short periods of time, especially when everybody wants companies to transform and change. So, I think we want to think about how do you protect the public markets? It is the intermediation of all of us and the influence that we have on these public companies, just the opportunity to really do it differently. That is what excites me.
That's really interesting. Let's pivot to talent. Hiring and developing talent in our industry remains incredibly important. And now we're doing so in an environment where there's an increasing awareness of the industry's lack of diversity, our focus on social justice issues, and younger workers' quest for purpose. So I'm going to open it up to each of you because you each have different perspectives and different sized companies on this, but clearly this is an issue each of us is dealing with, whether it's hiring, developing talent, just keeping talent, part of the Great Resignation. So you want to start and just talk about it?
Sure. When I had my first child in the early 90s, I remember my boss at the time told me that he was speaking with a senior person at my then employer, and he commented that he was glad to see my husband made the decision to stay home with our children. His comment to my boss was, "I'm glad to see she takes her career seriously." And I remember I was so taken aback, I was so shocked at the time at that thought process. And I remember thinking, you know, I don't know, so if I had gotten daycare, I'm not serious about my career. I was very incensed about it. Now, when my own children and their friends and other junior employees tell me they're not they want to know, like, what's the meaning of what we're doing, and they are not going to work the sort of hours that I worked and we worked early in our careers. They don't want to be in an office. I feel like the manager who told my boss that I'm glad she's serious about her career. My first thought is, well, that won't work. That's not good, you know. But I think just as we changed the industry, and Tom, you talked a lot about how things have changed. They have changed, and for the better, I believe. And so I think there is a big challenge for people like me who grew up in a different environment and in a different competitive landscape to listen, and to listen appropriately, and to make changes while still, you know, being successful and being competitive, and focusing on, you know, the most important things. So I think being authentic to your values, you know, you mentioned culture, Carol, I totally agree. So being clear about what your culture is and making sure that people understand it before they join the firm, I think is critical. But also I think we are in a position of having to listen in a way that I think maybe past generations of leaders had it maybe a little bit easier than we do.
When we first sent employees back, I was in the office that day. I was going to be there, and I was standing there at 4 o'clock. I was the only one there, and I was like, what? Okay, this doesn't work. And then I was like, okay, well, a month ago, I didn't know where everybody was at 4 o'clock, so why do I care now? You know, I mean, it's definitely a mindset change. You want to give your thoughts on the?
Yeah, I mean, it's sort of echoing Jennifer's comments. It is about figuring out how to be an inclusive leader, which means something very different today than it did even 10 years ago. And I think we're all working so hard on changing the demographics of the industry and the pipeline, and getting a diverse population into the investment industry. And it's because I think we all very deeply believe that better companies are run with diverse minds and diverse people and different cultures. And fortunately, I think we've been able to witness that just even running a global business, as I'm sure your experiences, you realize how much you can reduce error, how much better you can become when you have that diversity of thought, as everybody talks about. I do think the linchpin, though, is really, again, what Jennifer just alluded to, and that's the culture of the firm. And to have diverse populations and then figure out whether your culture fits it or not, and this is going to take time, but it is about evolving the culture and making sure that you as leaders can pass on what is so valuable and you protect from the past, like having a long-term view or the value of a long-term view, but then the ability to be open and listen and change and recognize, you know what, the idea of just sucking it up and doing whatever it takes and running through the wall that, felt like the generation we grew up in, I don't mean that they won't do that. I think we've got a higher order purpose that we have to continue to present to them so that they are incredibly motivated. I think the way we all were when we got into the business to say, you know what, this is something much bigger than me. I do want to be part of the fact that I'm going to help somebody retire, or that this is about putting somebody else's money to work responsibly. Like, wow. And then you think of this generation and you think of the diversity opportunities. This is what people want. And there's no better industry but ours to realize the impact you can have around the world. So
Before moving over to you, Tom, do you think that that can be sustained without physical interaction? Or does there have to be physical interaction to cultivate that culture?
I absolutely believe culture is about trust. Trust takes time, but trust also needs to be in person. It needs to be built. And so whether it is that combination of in-person and virtual, I can't believe how much trust I've been able to even build virtually.
Me too.
It's kind of neat. I think our psyches start to change, and you develop the ability to really figure out the cues. But I do think the energy, there is something, and we've just had our investment roundtable last week, and then we had our distribution roundtable a couple of months ago. Or just even being in this room, I mean, the energy was off the charts. And again, if you need to speed up building trust and getting to know each other, and that makes better investment decisions and better business decisions, I think it's worth its weight in gold.
I think Zoom kind of personalized people a little bit because you were in their home for 2 years, when you're having meetings and things like that, it made a difference. But Tom, how about you?
Well, I think if you look at the world of 2019, the things that we're talking about here were starting to happen, and we're moving at a kind of a trickle pace. Certainly, more people were working from home, requests for flex time, starting to use video technology. Though I remember anytime I was ever on a video call, there was someone from IT kind of hovering in the background in case I lost my connection, which happened about half the time. And then comes the pandemic, where all of a sudden, just at warp speed, we have to be self-starters when it comes to logging into a Zoom call, which I've gotten better at. But also overnight, literally overnight, going from the norm being, most people are in the office most days to no one is in the office for essentially a year, and very few people were in the office for the next year. And we're still coming to grips with that, and I think we'll be coming to grips with that for a long time. It seems very clear that the new norm won't be the same as the old norm. We're never going back to that world. But the challenge, and other people have touched on this, is how do you build and maintain a culture and connectivity and mentorship and all of that? I think you have to be very purposeful about how you used your time together. I mean, yeah, we were all in the same office all the time, but it wasn't like we were talking to each other. But you have to be, I think, very focused on making sure that during whatever part of the week when people are together, you use that as a time to really do things collaboratively and work cooperatively and make sure that you're really almost forcing people to interact on those days when we're together. The thing I worry about is that new group of employees who came in during the pandemic, two kind of mutually inconsistent things that I think that they felt. One, very focused on wanting to continue to work from home. That's one, in many cases, not all, but in many cases. And two, not really feeling a sense of connection, a sense of purpose in their job. Well, of course, those two things going together, and it seems to me you almost have to, we're never going to have the radical going back to the old way, but you really need to, I think in many cases, break that old habit of working from home, not just for the good of the organization, but for the good of the people. Done right, work can be a source of great relationships, a sense of being part of a team, a sense of mission in your life. We need to make sure that those things aren't sacrificed in the interest of the convenience of working from home.
I did the first week back again, and this is kind of funny, but I get there and everybody's sitting in their office with their door closed. I was like, I thought everybody wanted to collaborate. and I literally threatened to take the doors and get rid of the doors so that people would have to come out. But I think people learned how to that privacy and that quiet and that focus that they had. I always had an open door policy, and people took advantage of it. And then somebody would walk in and go, "You've got 5 minutes." And I was like, "Sure, as long as we both acknowledge it's 30. And then that stops whatever you're doing." And so I do think I think the pendulum probably has swung too far, and we'll swing back towards some more physical interaction.
Somebody was mentioning, I was in Australia last week, and somebody was talking about on stage, and he said, I had a situation when we finally came back in the office. I interacted with a colleague, actually a junior person that had been hired during COVID. We were in the kitchen, and he asked me a question. And it was a fairly simple question, and it probably was a 3-minute conversation, and I gave him the answer, and I gave him what he needed. And he said they parted ways, and then he ran down the hall, and he got him, and he said, hang on. He said, actually, if I weren't in the kitchen with you right that, how long would have that taken you to get that answer? And he said, would you have called me? He said, no. Mm-hmm. Would you have emailed me to set up a meeting? No. And then, so how would you have got it? Well, I would have called and done it. And he said, probably take him an hour. Okay. So anyway, it was, I thought, a really good live example.
Well, we're down to about 5 minutes, so I thought we could end maybe with a more generic question to each of you that sort of, what are you most excited about right now, sitting where we are, and what is your biggest challenge?
Excited about, bear with me, the metaverse. You can roll your eyes. Persistent.
The good news is you can't see him do it.
That's right. So sort of persistent shared virtual reality. So if you've never put on Oculus glasses and spent 5 minutes in virtual reality, I'm begging you to do it. I was with a senior investor last week, and he was telling me about how he didn't believe in virtual reality because he got an Oculus glasses on. He was playing ping pong with a friend of his in Hong Kong. And when he put his hand on the table to get a hard shot, he fell over because there was no table there. And to him, that was proof that this is not going to work. And I said to him, what I got out of your story is it took you less than 5 minutes to believe you were playing ping pong with this guy and put your hand on the table. I mean, I was blown away by how those experiences have improved. So I'm begging you to consider the metaverse, and I think it helps address some of the things we've just been talking about. The thing I'm most worried about is fragmented attention. I think my attention is fragmented, and so is everybody else's that I'm trying to reach and we're trying to talk to. And you may know Annie Duke. She's a favorite of Warren Buffett and Charlie Munger. She's a professional poker player, but also a brain specialist. And her point is, our brains work the way they work. They're hardwired. You can't change it. Social media, for example, is optimized to take advantage of how your brain is hardwired. So you have to give yourself tools and structures to cope with that. So I've certainly found that to be true.
Cool.
Yeah, I think I already mentioned sort of what I was most excited about. And I think that the days of obsessive growth, endless growth, and just profits at any cost, and the idea of just solely focused on the shareholder, we've all talked about it, is moving to this stakeholder capital world where the shareholder still remains critically important, but it is the community, the employee, and the customer, and to think of things more holistically. And I think that's where the shift of capital is moving. And to me, it's not at the cost of growing, like what are we going to do if we can't keep growing? Where the money is going to be made is in the transformation of companies, of all of us. And that's the opportunity and the leadership that will be created there. That, to me, is what's most exciting, because I think the next generation will get so excited about that if they see the reality of what's happening. And I think the thing that I worried about is just trying to make incremental changes to protect the system we're in. I think we've got a huge opportunity to just not do that and go bold and really press against the things that are our comfort zones that are going to hold us back from a stakeholder capital world. And if we think of playing a bigger game, I think the opportunities are endless.
Coming full circle, we'll give you the last word.
I'll talk about the markets. Challenges, opportunities. Challenges, it's not clear where to go. A lot of risk out there in the market, a lot of things to be worried about. Opportunities, if you're in the business of advising people on what to do with their money, you need there to be uncertainty. You need an environment in which you can help clients make better decisions. The psychology of being an investor in an upmarket is different, and in some ways easier, in many ways easier than being an effective investor in a volatile market or a down market. From the point of view of being an active manager, the volatility that's happened over this year creates enormous opportunities. Many of the companies that are positioned to benefit from changes in technologies or changes in society going forward are available at a 30, 40, 50, 60, 70% discount to where they were 9 months ago. So I think for the business that we're in, investing and providing investment advice and services to clients, this is a great environment. A little scary, but also a great time to really distinguish yourself with your clients. People aren't going to remember, who made a decent choice for them in a market that goes up 10%. What they're going to remember is who gave them advice that helped them either avoid the downturn or more likely position them to benefit from the upturn when it might not have been clear to anyone that it was a prudent thing to do to put more money into risk assets. That day's going to come, and if you're in a position to help clients make that call right, I think you're in a wonderful position to make a client and a friend for life.
Well, thank you, everybody. I think our time is up. Thank you guys for that and your insights. Thank you very much.